Hey, Tommy from Finance with the Limbs here. Tonight, we have a special episode for you. It's the first in a new series called The Bottomline, where we discuss investing ideas and much more with a guest. Our guest tonight is an expert on Chinese companies, a long-time Alibaba bull, and a self-proclaimed clown on YouTube. Keng, welcome to the show.
Hey, thanks, Tommy. My name is Keng. I do run a small YouTube channel, and yeah, I do proclaim myself as a clown on the internet because I think a lot of things online should not be taken too seriously, and you should just take whatever by the pinch of the salt. But that's it. Of course, I don't proclaim myself as any forms of expert. I think people just make that connection, or people just because I say something and reiterate it on a consistent basis, then people think that I'm an expert. But of course, I'm still learning. But yeah, thanks, Tommy, for that great introduction.
How do you reconcile going the line of financial advice? Because that's one thing I notice. It's usually a huge headache for YouTubers. At which point do people start taking you too seriously and just double down when you seem like you're really confident on something? They just almost go all in. Right. How do you reconcile that tension?
Right, I understand. I think actually I did search it out. I think recently there was a video that was posted by the Plain Bagel. I think he's also quite a huge finance sort of YouTuber in this YouTube space. And he actually did discuss with one of his law friends, asking whether this quote-unquote disclaimer of not financial advice actually abstain you from all the different legal proceedings and stuff. But apparently it does not. So I think at least on this online medium, personally, I do believe that there are a lot of people that take things extremely seriously and they go all out and they really sought advice on an online medium. I think not only on YouTube, people go onto forums like Hardware Zone, or even a lot of all those investing note, for example, and then people come in as a community and then they start discussing about finance picks, personal finance, etc. The problem with this is I personally feel, of course, I believe that the onus is always on the listener or on the people that participate in this kind of activity, because that's it. You can't really control what people have to say, and people have what they can discuss, or whether are their claims even legitimate, and what's the veracity of all the different arguments that they put forth. So that said, you have to exercise a certain degree of critical thinking, a certain degree of researching on your own, and that's something that I cannot control. So at least personally, on a personal level, I try to do as much research as I can. Of course, I fumble from time to time. I do put out, I won't say dishonest information, but really sometimes the benefit of the doubt that I might have misread a certain paragraph, I might have misseen or mislooked some of the numbers. So that said, of course, I'm not abstain from, and I'm not perfect. So to human is error. If I'm not wrong, that's the proverb. But I really do encourage people, especially when you're trying to take advice from people online. Please know everyone has their own agenda, and a lot of us are all biased in a certain degree. So just know that and protect yourself. I think that's the most I can tell to all the different audiences out there.
Yeah, so this is I guess a note to all content creators, not just ourselves, that we have to be sincere and take as much responsibility, at least as with all the information you have at the time where you create something that looks like investment advice, but it is not, of course.
Yeah.
Okay, I want to start off with Alibaba, because that's what you are most likely known for. Surprise. So, on Alibaba's sort of numbers, right? How do you reconcile the different accounting practices between the US and Chinese companies? So personally, I'm not a accounting expert, and I've not studied finance at all. So, but from what I understand, people are usually a bit more shaky when it's not GAAP earnings.
Yes.
So how do you as an investor yourself reconcile that, and how do you bake that in terms of discounted risk, let's say over 5 years? Yeah.
Understand. So personally, I think on that question, it's a valid concern. I think many people do have that concern. I'm currently doing a finance degree. I'm doing an accounting degree as well. I don't think I'm the most qualified because I have not graduated, and I don't want to tarnish my own university's reputation. But all else being said, as as an accounting undergraduate or as an accounting major student, I think it's definitely concerning to many investors, specifically about this entire Chinese-US tension, how people are afraid of fraudulent numbers, etc. And from the way I see it, it's something that probably can never be reconciled. I think to give it to you straight, if I were to answer it, simply put, it cannot be reconciled because let's not talk about the Chinese and US. Even Singapore's accounting standard and the US accounting standard has a fair bit of differences. Of course, there is the international standard, and then there are the nuances in your own localized context.
Right.
So in that sense, there will never be a perfect standard. So what the international community try to do is they try to set the baseline. But now the issue is, what if we have contentions on the baseline? Then how do we go about trying to absolve those differences? So in this case, I think personally, especially being invested and looking through all the financial data and financial numbers of Chinese equity specifically. So if your Alibaba, your Tencent, your Baidu, largely speaking, we would tend to believe a lot of their numbers more than compared to, let's say, a random small boutique company in China. Maybe they call themselves Zhejiang Tourism or Zhejiang Mummy's Bakery. I think in comparison, if you were to look at international companies, companies with huge exposure, you tend to trust the numbers a little bit more. But that said, what happens if they themselves are also fraud? So in those cases, you have people like Luckin Coffee, for example. I would just like to remind everyone that accounting fraud is not, China don't run a monopoly on accounting frauds. I think frauds happen at every single part of the globe. So there are always issues in different countries, and Enron is a classic example on how US is also at the mercy of this kind of the different companies or management trying to manipulate earnings and trying to defraud different shareholders or consumers, etc. So in this case, I think it's always a learning process for all the different companies out there. US is learning, China is learning, but I believe China has a lot more to learn and a lot more to catch up because they're quite late to this entire capitalistic game. But I'll just like to remind everyone that, hey, China, it's not a problem that only plagues China. That's the first point. And on the second point, people are also afraid that, hey, what if they are reporting bad earnings or they try to, they have malicious intent? Then you start looking at the history of the company. You start looking at how the team has executed. And if the company is here for over 10, 20, 30 years, the business is ever expanding, more and more people are using their products, then maybe you might want to think again on whether are there any merits to people constantly shilling out and saying that, oh, all the numbers out from China is all fake. I think to the extent that the credibility of the Chinese government now is people don't even trust their GDP numbers anymore. So that's definitely a topic for another day. But in terms of trying to, I would only say you have to take your own risks. And this risk is prevalent in every single company, but the risk might be higher in China specifically. So it really depends on your profile and how you want to tackle this problem yourself on a personal level.
Right, yeah.
Yeah.
So I agree with almost basically everything you said. And one thing I find myself struggling with is like trying to reconcile how do you invest in a company that I cannot get my hands on and like see other people using. So those are the ones that usually I tend to stay away from. So like at least Alibaba, right? There's Lazada. There's stuff you can test out. If it's a scam, there are many eyeballs on it, and then you'll be like one of the biggest scams of all time if it turns out to be true. So there's a little bit of assurance there at least. Yeah. So my follow-up question would be like, does the CCP care for the success of some of the companies that, nowadays we like to talk about homecoming, they like come back, common prosperity and whatnot. So do they still care about, say, TT, Luckin Coffee, and other public companies that have so-called like abandoned their people, gone out? Yeah. I think
personally, everything is personal opinion, of course. Personally, I feel like all these different private enterprises or arms of different enterprises, they are a form of means to an end, and that end is quite clear, to bring prosperity to the people, to make China great again. So there's this interesting rhetoric by Trump, right? By ex-President Trump. He wants to make America great again. Personally, I think America is already great. They have nothing to be great again. They are still great. Like, they are the greatest country, in my own opinion. China, on the other hand, I think they suffered a huge amount of humiliation, at least for the last 50, 100, 200 years. They were at the back of a lot of all the different more westernized countries. And if I'm not wrong, I think at least in the olden times, they do make up around 30 to 35% of the world GDP. That was in the early, I don't know, in the BCs or whatever. But that said, you can see that, or you can at least observe that, hey, China has been deteriorating at least in the last 50 years. The last 50 years, they have been deteriorating. They have been essentially exploited, if I can use that word. So in this case, I think it's really the revitalization and really the ambition to come back greater and to come back stronger. So if you were to look at all these different private enterprises or different companies, there are all just methods to try to help alleviate and to help quicken that process. And in order for you to be a great power, in order for you to be great again, you have to have all these credible companies, people that are supporting of your products, of your services, people that can look up to, and people that have companies that people want to work in and to contribute back to the company. Yeah. So in that case, I think at least in the last 10 years, China did put on more and more emphasis in trying to make a lot of their companies or enterprises a lot more credible. I think if you were to study back in the 2000s, they couldn't care less. As long as there's money, you generate revenue, I'm going to do it. But then they start to slowly realize that, hey, maybe credibility is one thing. Maybe trust also is worth something. And then they start reevaluating their position again, and they start looking into, hey, is there really worth in trying to essentially make the international community look into China again, and if they want to invest. And of course, the credibility is just one arm of the entire argument. On the other arms you have things like international fund flow. You have things like whether investors are the ones that hold a huge ton of money. So are they even comfortable putting money into your economy to help you drive your economy, drive your GDP, etc. So all these are different facades of the same equation. And I think that being a politician is an extremely tiring job. Being a government is an extremely tiring job. So in that essence, there are many levers that the government is trying to weigh now. And I from as far as I can tell, gaining credibility is just, it will be a process. It's a work in progress, but I don't think that's very high up in the priority list, because there are a lot of things that they are concerned about right now. There are more things that are a lot more urgent. Right. So to me, we can take the next 10, 20 years to appreciate how they try to internationalize the names, the big brand names, how they try to gain more international market share. But I personally don't think that's a priority thus far in today's context, at least.
Right. And do you think that would cause more downward pressure, basically? Because if it's not a priority, like hedge funds and institutional investors will not sniff out that, there's a sweet spot of...
Right. Actually, I totally do agree on that entire rhetoric, which is also why I think there are friends, people in the community, and some of my viewers asking me, why are you catching that falling knife? It's going to be a long wait ahead. Why do you want to get invested so early on? You can start playing around other markets first, and then when there might be signs of reversal, maybe you can go into the Chinese market again. I think to that, I only probably have like 3 responses. Number 1, I think there's this Chinese saying, I will help translate later. So there's this Chinese saying, 为什么杀头的生意有人做，而亏本的生意没人做? Essentially what it means is, why are there businesses that people are risking their lives to do, but there are still people that are willing to do it. But whenever businesses are losing money or it's a guaranteed loss, nobody's willing to touch it with a 10-foot pole. So in this case, sooner or later, hedge funds are going to rotate back in. I think to me, looking at it, it's a cyclical movement. Hedge funds moving in and out of Chinese big tech or even Chinese companies specifically. Let's just look back in 2015. If I were to just pull out a few numbers, let's take Alibaba for example as well. In 2015, their enterprise value to the revenue, enterprise value to last 12-month revenue was around 13.6, and in today it's 2.45. Enterprise value to free cash flow in 2015 was 25 times. Today it's 13 times. So don't tell me that in 2015 they had more trust in China than compared to today. I think a lot of all these risks that are involved, it's the same. China is still under CCP. It's still under Chairman Xi. In 2015 it's Chairman Xi. In 2022 it's still Chairman Xi, and he's still going to be elected for life again. Whether barring the fact that if he's assassinated, of course. But anyway, if we are looking at it in this lens, you can really see that it's a cyclical movement. Hedge funds will always be searching in search of that next big thing or the opportunity to earn money and to generate alpha. So in this case, I'm not really worried because sooner or later the movements back into Chinese big tech, they will fall in favor again. And there's this very interesting narrative that says a lot of people like to believe that price action is driven by fundamental changes. I personally think that it's the price patterns that dictate the narrative. So if the company keeps falling, it's a bad company. You look at it, margins is shrinking or revenue is decreasing, but nobody gives any disregard. They disregard all the different macroeconomic factors, some of the explanations, etc. So that's on one. On point number two, I fundamentally believe that because of course, some of the concerns are legitimate, by the way. So companies or the government is putting on pressures. People are it's for the greater good. There's this common prosperity push. All I totally agree. But then we come to ask ourselves as shareholders, what do we want? We want sustainable long-term growth, right? But the problem is a lot of people like to squeeze the short-term profits. They like a hit and run. They like to see profits jump 100% year on year. You grow 50% CAGR for the next 5 years. But are these sustainable or not? We don't really know. I think that's a question that we say that, maybe you ask 5 years later. Let's not think about it now. If you are able to derive revenue and profits now, I want to take it now. And that's the issue. If you're investing in China, you have to adopt an extremely long-term view. It has to be sustainable because like Ant Group, for example, Ant is growing enormously. The growth was tremendous. The amount of value that they provide was also tremendous, but it also brings in a huge amount of systemic risk, which is concerning the government. If I am Chairman C today, for example, if you can constantly just loan out loans and disperse loans, and you take only 3% of the take, then or you only risk 3% having skin in that game, then I really highly doubt the amount of risk that you actually care when you are doing all the processing. That's on point number two. We want sustainable long-term growth. And point number three, really to answer about this catching the falling knife thing, I think there's always a classic explanation. Time in the market always beats timing the market. I know I'm a bad market timer. Every time I tried to time the market, I sold Apple at 140, 150, and I thought I was a genius. And then look at where Apple is today. So in this case, if you buy into companies or you buy into specific stocks, at the end of the day, if of course this is advice only to people. No, I wouldn't say advice. Of course, I cannot dig a hole for myself. But if you were to look at it, if you have an extremely huge time horizon, if it's extremely long, and if you're in the accumulation phase, I don't see why you are timing that few tens of dollars of difference, and then you say that maybe in 10 years I'm able to expound my money more. That's a very dangerous mindset to begin with. That's one. And on number two, I know that, and I'm ignorant enough to know. I'm ignorant. I know that I'm ignorant to be able to time the bottom. So in this case, I look into a business. I like the fundamentals. I like the valuation. I buy. That's as simple as it is. And if it's down 30%, 40%, 50%, I ask myself, I was happy when Alibaba was at 170, 180. It's at $100 now. Am I supposed to be even happier, or am I supposed to start getting worried about my investment? I think that's the primary difference between trying to time the market and catching the falling knife or whatnot. So yeah,
right. Yeah, I agree with your ideas. So like for me, I'm personally very bad at timing the market as well. Like personal experience of selling Tesla too early, selling TSMC too early. So those are the two big examples I can think of off the top, that not taking a long-term view actually hurt me more than like trying to be clever. So engineers would call this like over engineering the
right.
So
I also do think that especially people as smart as you, or as smart as a lot of people that actually come onto YouTube to watch investing advice, they always mix things up. So in economics 101, and maybe in high school economics, they teach you opportunity cost, right? Whoa, so you deploy your capital here and then look at the amount of opportunity you lost. And then it's always hindsight bias.
Yeah.
They always like to compare. Look at the amount of money you lost in Alibaba. What if you deployed the capital in Tesla, for example? Look at how much money, what's the delta difference that you're experiencing? All these are hindsight. It's 2020. Nobody knows what's going to happen. And you just buy based on your own risk profile and how you're going to construct your own portfolio. We can't really take into account, in this case, if Alibaba were to spring up 300 tomorrow, so who's the genius one then? Because there is always a timeline in how you try to compare for results, right? Yeah. And that's a very dangerous thing to do, because you'll always be in the rabbit hole trying to chase let's evaluate, hey, is this investment a good one? What if tomorrow suddenly a 20% return year on year investment starts popping up and it's
exactly
sent to your table? Are you going to sell out and take that opportunity?
Yeah, and when people talk about opportunity cost, they almost never talk about how do you get the data at the right time so that you can even make that, to know what you missed out on. That itself, it's perhaps just as big as the opportunity cost. It's also a cost.
Right.
Cost to your standard of, you have to sacrifice things in your life, right? To be always so ahead of the game. You have to know how the OTC markets work. You have to know how the hedge funds are thinking, all of that.
Right.
To be a trader, which is why more people are long-term investors, I think, statistically.
Right.
Yeah, it's just harder to be a trader in general. Nothing wrong with it. Those people are have their own thing going on. We don't know about it, so we tend to stay away.
Right. The funny thing is, a lot of people like to think that they're long-term investors, but if you look at the activities in their trading account, I think a lot of us are not, because we are easily swayed by all the emotions, market-driven sentiments. Hey, it might be a lot expensive now, let's take a little bit of profits off the table, and then they don't stick to their gun. But if you were to look at GOATs, like Warren Buffett, he held Coca-Cola all the freaking way. He just accumulates and accumulates and accumulates and accumulates, and that's the kind of investment temperament that I think people always strive to achieve, but always
get distracted along the way. Right? Get distracted along the way. That I struggle with that as well. And of course, it's a learning process, and I aim to get enough conviction on my positions that I almost see myself as a business owner.
Right.
And that's how I was able to just double down when the market is, afraid.
Yes.
Okay, so a follow-up question would be, how do you look at the qualitative features of Alibaba? Like what aspects of their management impresses you, and how do you see their competitive advantage? Do you think that they can maintain their market share moving forward?
Right. Okay. So maybe it's two parts, right? I'll answer about the qualitative aspects of the management team first. So there's this saying about of course, for those of you who do not know, Alibaba is actually founded by Jack Ma and a few of his business partners. I think there's this internet discussion of Sipa Lohan, which is he and his team of experts and team of generals that led Alibaba to where they are today. So in terms of execution wise, I think you really have to give it to them. At least in the Chinese tech sector, in the US you have the FANGs, right? Your Facebook, Amazon, Apple, Google, etc. And then in China you have your BET, which is your Baidu, Tencent, and Alibaba. So in this case, you can see that a lot of the competition or a lot of discussions surrounding many of the industries, like really a ton of industries, social media, e-commerce, Internet of Things, etc., the list goes on. It's dominated by the three of them. But of course, recently there are new pop-ups like Meituan, Kuaishou, ByteDance. All these start popping up and start joining into the scene as well. But at least for the last 20 years, if I were to look at how the management team of Alibaba have executed, you really cannot not give it to them. So let me give you an example. They have 4 main arms in Alibaba: their e-commerce arm, their logistics arm, their finance arm, and their cloud computing arm. Out of the 4, they are dominant in 3. By dominant, I mean they win Tencent, they win Baidu, they win Huawei. All these, Huawei is a state-owned enterprise, by the way. It's controlled by the government, or there are stakes by the government. And Alibaba still managed to come out on top of all this. E-commerce, they hold 50%. The next closest competitor, JD, hold 20-odd%. In cloud, they hold 40%. Or 35 to 38%. The next closest competitor, Tencent, at around 20-odd% as well. And in finance, at least in the mobile payment arm, they own 50-odd%. Tencent's WeChat Pay, they hold around 30 to 40%. So in this case, if you were to look at it, you really can't say that they can't execute, because in this instance, they prove to you that, hey, out of 4, they dominate 3. In terms of the logistics arm, I don't really have the numbers crunched at the back of my head, but you can tell that they are of a certain size and caliber. If not, they will not be able to serve such a huge market in China specifically. So I wouldn't make the claim that they are the best, but at least I know out of the 4, they're the best in 3. That's the first part. Then, of course, I have to play devil's advocate here. they attempted to try to disrupt the social media industry and take on WeChat as well, and they failed. So in this case, they only got currently, if I'm not wrong, a 20% stake in Weibo, which is China's version of Twitter. But in this case, they tried to build an app on their own, and they failed to gain market share. They failed to compete. So that was also a kind of a blemish on their papers. Doesn't mean that every single project that they take or every single initiative that they take, they manage to execute it well. So this is the kind of execution risk that how you are looking and how you are positioned to look at Alibaba. So I'll leave it up to you to decide whether the management is able to continue executing. So that's the first part. And on the second part, now a lot of people like to talk about this might be the Yahoo moment of Alibaba, right? Because they are slowly losing competitive advantage. They are slowly losing market share. The e-commerce arm facing massive amount of headwind, not only from JD and Pinduoduo. Now ByteDance wants to come in, Kuaishou wants to come in. Every single Huya, Douyu also wants to come in. All the live streaming platforms want to come in. Then even in the Ant Group, for example, now digital renminbi is going to kill and financial Ant Group, for example, because they won't use mobile payments anymore. I believe, at least in a lot of all this narrative building, right, there are always kernels of truth. So maybe in the .com bubble, right, everybody thought internet was the next big thing, and it is. Internet was the next big thing. But if you invest in something like pets.com, for example, it's nowhere to be seen today. And even for Amazon, you invested in $100, it dropped 90% to $3. But if you held true, Amazon is a few $1,000 today a share. So in this case, a lot of all this narrative building and a lot of all these stories, right? Essentially, Alibaba kind of lost its story, especially in the crackdown. Right. At the peak of the crackdown, a lot of people are saying that, the Chinese government is going to kill them, competition is too strong, they're not innovating fast enough, the list goes on, and I don't want to reiterate the points. But that said, then, as an investor, you will then have to make that qualitative judgment yourself. Are they able to come out even stronger from this? That's the first question you have to ask yourself. Number two, a lot of all the product offerings, especially when you're a consumer of all those Lazada, Taobao, some of you in China, you use all the different apps, Ele.me, Xianyu, etc. These are real products, and you use it every day, and they're generating revenue every day. And you have a cold hard look at it, and you think about it. Are you stick to this product? Do you have loyalty to the product itself? Or do you think that it's easily replaceable? And that's only a judgment that you can make on your own. So like Facebook, people say that, hey, Facebook might be also experiencing a Yahoo moment. So everybody seems to be experiencing a Yahoo moment that they might be disrupted by everyone, right? So that's a lot on the story and how they lost their story over time. So in this case, you have to make a lot of the different judgment on your own, onto thinking whether you believe that the company is able to come back and come out stronger. And on the last point on whether in terms of competitive advantage and in finance, we like to call it economic moat, right? I would like to echo what Charlie Munger actually said in his latest Daily Journals interview. He actually did compare Alibaba with Google and which is Alphabet, the parent company, and Apple. So I personally also have to agree to that. If you're to compare the business model based on merits itself, of course, Alibaba is not as entrenched as Apple or as Google. I think the funny thing is it's extremely hard to find any other companies that can come and can rival Google, for example. Even Jeff Bezos said that Google is a mountain. It can be conquered, but it can't be moved. So in that sense, there are really no close competition to all these different companies. That said though, does not mean that they would be here 10, 20, 30 years ago. Nobody knows. The world is fluid, and that's exactly how you exploit opportunities. But I'd like to acknowledge the fact that, hey, Alibaba is definitely experiencing a good amount of competition, a good amount of headwind thus far. And then you will have to see that, because in this transition phase, you know that we are kind of at the maturing stage of the curve. So it really then depends on whether you're betting on the next stage of the curve, where for Facebook, it's the metaverse, and for Alibaba, in my own opinion, it's the international commerce arm, and it's a cloud computing arm as well. So that's just my own general gist about the management team by and large, and also how Alibaba's trying to enhance and trying to continuously provide value to the marketplace.
Nice, yeah. Hopefully, like, this sort of train of thought can help like existing investors as well as potential investors to risk adjust, how much you want to go long on Alibaba.
Right.
Because the game might be pretty long. Like Amazon was not profitable for I think more than 10 years, right? Before the price just skyrocketed. And who would have believed you if you told them on year 2 that this is the 10x stock of the internet age? So time will tell.
Right.
Moving on from Alibaba, I want to talk about like the international markets in general. So I made one episode about like Macrotrends. So I talked a bit about fintech, like green tech, and the metaverse. So what do you see as big trends coming up for the next decade that you use to sort of source your ideas for investing around? Yeah.
I think that's really a very interesting question, and especially for young people like us. Of course, I would qualify us as young. I think we are the future of this entire globe, and whatever we are thinking on our minds, that's where we will put in our time, our effort, and how we will try to help break that frontier in our own capacity, be it in work or even in our own free time. So personally, I do understand that there are quite a few very hot topics. So you have people like blockchain, green tech, all these metaverse. So all these huge topics, or a lot of the discussions online, or at least in the online realm, revolves around all these different discussions. Personally though, I'm actually quite excited in terms of AI and automation. Not trying to be a skeptic of replacing low-end jobs and a lot of all these mundane jobs, right? But if you were to look at it, the trajectory seems, at least in these two fields, right? AI and automation, there are practical users. I'm not saying that, of course, I'm not saying metaverse has no practical use, but it seems like a lot more funds, a lot more concentration in all these different, trying to make all this come into fruition, like make all this really turn into reality, because there is a business need to it. If you can drive costs down, you can increase margins. All these are real value addedness to all the different businesses and enterprises. So that's one. That's one trend. The second trend I do agree is actually personally I have been researching, or at least attempting to research into the green tech space, and especially all these solar talks, a lot of all this sustainability and a lot of ESG kind of thing, right? But I feel like there will definitely be a time for it to shine, but I will have to be prepared to be able to take advantage of that curve. So I have to do my own homework. I have to understand what it means, what are the companies pushing for, and all the different panels and what are the cost economics, etc. But that said, because I know that I'm not that geeky about it, in comparison to like technology, for example, I might be more interested in Facebook or Amazon's business model rather than people selling solar panels. So in that case, I'm actually looking into trying to increase my exposure in terms of at least an ETF. And whether is it a broad-based ETF that comprises of the whole world's solar or green tech related companies, or China-related one, I think maybe I'll do a video to cover that. But I personally now, I look towards, or at least I'm tending towards more Chinese-related, because I seem to have more affinity with a lot of all these Chinese companies. And I think if you look at the trends and what are the commitments of the highest level of governance and how all the different countries are pressuring each other, I think you probably cannot really go wrong if you're betting on this sector, and specifically if you're betting on China. But then, of course, again, a lot of political risk, execution risk, and all this. So you will have to do your own due diligence and to look into how you are able to stomach those on your own. Yeah. So these are the two trends that I personally am more interested in.
AI computing and what was the second one? How would
green tech.
Green tech as a general.
Yeah.
Okay, cool.
Yeah.
Cool. So I have to remind myself that like there's a commitment required to get into a new industry, like the amount of time you need to do research. So it's like I'm not rushing into it myself, although I'm interested in all of those macro trends. Okay, next question would be for a young investor like yourself and to a lesser extent myself, what characteristics of a business do you think attracts and is worthy of that attraction, like something that you can hold for until your retirement age? What do you think young investors should look out for in a company, that X factor, if you will?
Right. I think it's a very tricky question, because I believe that in your entire investment journey thus far, you will definitely pivot. You will definitely look into your entire investment approach. in different stages of life, at a different life cycle, there will definitely be different opportunities. That's one. There'll be different objectives as well. So in this case, I can't really prescribe because it's on a very individualized basis, and because we're not financial advisors, it's always best to try to find someone a lot more professional, and it's their day-to-day job to advise you on what to do. But personally, if you were to ask me as a blanket question, if just specifically for young people, what investment instruments or what industries should you be looking at, I would venture you guys to look into higher risk assets, like equities, not so much into bonds, maybe sometimes even into cryptocurrencies. Of course, barring the fact that, or with the caveat that, hey, you know what you're doing, you know what you're investing in, and you really believe in what you invest. Because the emotional turmoil when you lose money, I think that's horrendous. And I do not wish anyone to experience that. But if you are invested in the market, that's something that you cannot run away from. So that's the thing, right? As the younger you are, unless you are like a Saudi prince or your parents are billionaires, you don't start out with an extremely huge capital. So by huge capital, I mean at least in the 6-7 digits. So if you're starting out at 5 digits, you have 10K, 20K, 50K to burn. Of course, I wouldn't say burn. It's a lesson to be learned. You are essentially paying school fees to the market. You learn yourself. Investing is a very expensive game to know yourself more. Screw all the personality tests, all the different psychiatric assessment, or even talking to a psychiatrist, for example. The stock market is the easiest and the fastest way to learn how you react as a person and to understand yourself on a much deeper level. So in that, if you look at it from that stance, I think for young people, at least in maybe their early 20s, late 20s, early 30s, it's good to always the lessons you learn can benefit you in the subsequent 30, 40 years when it's achieving that compounding effect. Yeah. Of course, if you're like a genius, you're like Buffett, since young he starts compounding at an astronomical rate, then kudos to you. Of course, I hope that you will do even better. But I think at least for people like myself, right now I'm also still learning, still investing, and still I'm trying to learn the ropes, get a lot of different advice and opinions from many different people. And which is also why I thought that YouTube as a platform is a very interesting platform. You get to hear all sorts of opinions. People that are pro-China, anti-China, people that are pro-equities, anti-equities, pro-cryptocurrency and anti-cryptocurrency. So these are the diverse amount of opinions that you have to take in. Some like to look into macroeconomic factors. Some like to talk about all the different industry-specific factors. All these are good information and good reference materials. But that said, if you're too busy, if let's say you're an engineer, you're a lawyer, you're a doctor, and you don't wish and you have no interest in this, stay invested by an S&P 500 dollar cost average. That's the easiest way and the I won't say the surefire way,
but time-tested, well-tested.
Right, it's time-tested. But maybe this is just my own opinion. I would like to put it out there because I think that it's not this entire thing that I'm going to say later on or in the subsequent sentences. I think not enough people are promoting it, or not enough people are raising awareness for it. It's true that the S&P 500 has went through the test of fire, went through World War I, World War II, all the Great Depression, all your different financial crises. That's it. That's a back-tested formula. They survived for 100 years. They return you a compounded average of 8 to 10%. Does not mean that they will continue returning the 8 to 10% for the next 50 years or for the next 100 years. Nobody here is to guarantee you that. Even the US dollar doesn't guarantee you anything. It has the backing of the US government. Who is to say that there might be a change in world order, there might be a change in how things are being perceived, and how you know that all the greatest companies of the world will stay in the S&P 500. I think all these are unknowns that we have to start getting comfortable with. And maybe for people that are in the older age band, in their 40s, maybe in their 50s, I think for people that have the tried and tested way, sure, carry on with your dollar cost averaging into a broad-based index. But I'm just trying to remind people that if you really want like a surefire way, maybe you might want to look into a international exposure broad-based ETF. I think there are a few that actually buys into the entire world economy. It diversifies across like 9,000 companies or something.
Right.
So maybe that might be a more hedging way, but of course your returns will be kept because you're diversified across so many things.
Yeah, and,
so
and,
that's just,
and if your investment goes down, the whole world goes down to more or less
Right.
together with it. So
Right.
you hedge your bet
Right.
on the world.
Right.
That's pretty interesting idea. Yeah.
Yeah. So that's my own take on S&P 500. Of course, personally, of course, I don't have exposure in the S&P 500. I would want to start it soon, maybe when I start working or when I have a full-time income coming in. But personally now, I'm taking quite a quote-unquote risky bet to a lot of people's eyes, because you start betting on companies means that you're increasing your risk exposure by tens of thousands of folds compared to a broad-based ETF, because there are company-specific risks and idiosyncratic risks that cannot be diversified away. So in that sense, you have to weigh the pros and cons in your own financial journey as well. Yeah.
Right. Yeah. I think like Peter Lynch said, right? Like investing is not even like not in the brain, it's the gut. Basically, it's like how much conviction can you have, and when you're young, if you're young and have the time to like spend a lot of time understanding a company really well, then you are risk adjusted. You are more likely to be risk adjusted, going long in that stock. So it really depends on your situation. But generally, I would say young people tend to have more time. So it'll be weird to see a young person like, almost all in completely bonds, SGS bonds, and like maybe old,
I think
like old blue chip dividend paying stocks. That's like kind of weird, I would say. Yeah.
Yeah. Actually, I do understand why some people just hate the idea of losing money. So they would rather have something that is capital guaranteed in nature, which is like bonds, for example, or some structured notes that give you capital guaranteed returns. But the issue then is you really have to understand yourself. And like I said, the market is the best way to understand yourself in the shortest period of time. So in that sense, I don't think that even though I do highly encourage people in their early 20s to go into 100% equity, might not be stock picking. You can go S&P 500 or buy KWEB, which is the Chinese internet tech sector. Up to you to decide. But that said, of course, we do have to take into account the ability to stomach. You being able to stomach 30%, 40% loss doesn't mean that somebody has that ability. Maybe once they hit 10%, they might want to cut loss because I can't sleep at night. And that's a very important barometer to know that whether you have that good night's rest, whether that you don't have to be constantly checking your portfolio, checking your brokerage account. That's a very toxic behavior to begin with. And if you go down to the core of investing, people invest for financial freedom. People invest because they want to make money. But if at the expense of your mental health, your mental well-being, your sleep, it loses its purpose. And I see no point if you're doing it that way. I'd rather you keep it in the bank and earn that 0.05% interest rate.
Good point. Yeah, that's a good point. All right, moving on. Let's talk about like starting investing, starting out in investing. What do you think is interesting about investing other than, the ability to reach financial freedom at an accelerated rate? Yeah, what do you find particularly interesting? Is it the history, like the amount of the way you can test your ideas with a huge community? Yeah, what's attractive to investing to you?
I think personally, when I first started out, the interesting thing was because I was exposed to equities market from a very young age. So from a very young age, everybody's, how would I put it? Their childhood dream was to be an astronaut or to be a policeman or whatever, right? I still remember vividly, I think it was in primary 3 or primary 2, when my teacher told me, what do you want to be when you grow up? If I'm not wrong, I wrote stockbroker or I wrote a banker, if I'm not wrong. I think my entire life was heavily influenced by my dad, because my dad is also an avid investor. He invests a lot. He had his fair share of being burnt in the 2008 crisis, even in the dot-com bubble as well. That said, I think it's for me personally, at first, of course, it's always to earn money, right? Everybody wants to earn money. Who doesn't want to? But people always don't talk about the downside risk. People don't talk about the ability for you to lose capital. When you have 50,000 and then it goes down 50%, you lost 25K. That's maybe one person's annual salary. And nobody talks about it. It's not glamorous to talk about losing money. And which is why everybody's risk profile is different. Your objectives are different as well. One person can say that Tesla is the best to the moon. Alibaba to the best to the moon. But you have to make that personal judgment yourself, especially if you are into stock picking. So which is why I definitely do encourage the general public to just stay invested by a broad-based ETF. But if you want to start picking stocks, Actually, from when I started understanding a lot more. Okay, so initially for my journey, right, I was buying blue chip stocks. I think I was under that category because why? I look around Singapore. You have Keppel Corp, you have your Sembcorp Industry, you have your DBS Bank. Those are the brands that I know. So of course I'll buy into those companies. But then you realize, and you come to realize about risk-reward ratio. You start realizing that, hey, you don't really understand the business model. You bought just because it's a Singapore household brand. Then I extracted my money out from all these blue chip stocks, and then I start venturing out into US equities, China equities, Hong Kong equities. And then currently, at least for now, the most alluring thing about investing is for me to really think of it from a business perspective. At least, or some of it might call it maybe I'm more of like the strategy department of the company. So what is the strategic advantage? What's the competitive advantage? How do I look at it from the point of view of the owners, or especially the chief executive? How is he trying to position himself? So when I think about GrabFood today, GrabFood deliveries, for foreign viewers, it's the equivalent of DoorDash, Uber, all those. It's a food delivering platform. If you think of it, if you go through the earnings call, you listen to how the management team pitch the company's end goal. The end goal is to be a super app. But if you were to really think about it, to me, why am I personally not invested into Grab? The business model is a profit-losing one. And out of every single company that are in the same industry, every single one of them are profit-losing. You can fact-check me on that. Meituan in China is losing money. They're not profitable. Uber is also not profitable. Even if you look at all the different out in Turkey, in Africa, you have all these food delivery providers as well. None of them are profitable. So what are they trying to achieve from this business model itself?
Winner takes most, right? Basically, winner takes most. Winner takes all, right. Or winner takes most.
Right. So the logic is they want to have the biggest market share, and then subsequently they can increase their prices. But then you realize that in the Singapore's case study, we started off with Uber, and then came in Grab. Then Uber got chased away. Then now we have Gojek, and then we have Food Panda, we have Deliveroo. And you realize that, hey, consumers are extremely price sensitive. You can say that, oh, today you have 80%, 90% of the market share. But tomorrow if Food Panda comes in, hey, I offer cheaper than Grab. You're going to switch over to Food Panda. You ask yourself as a consumer, when you make the purchase beforehand, you'll start switching into apps and see which is cheaper. Because the service that is provided is not differentiated. It's the same. You want to get from point A to point B, or you want KFC today. So the real differentiating factor here is time and probably the cost. So in this case, there really isn't an economic moat surrounding the company. And if you have to think about it from a strategy front, what are you supposed to do now? Yes, I pivot. I want to be a super app. I want to earn money from my finance arm as well. I don't want to just be a food delivery platform. I want to start charging loans. I want to be able to give you credit. I want to earn the interest rate, and I want to start going to fintech and disrupt banks. So that's a good strategy. That's something that we can work with. But that's it. There are a lot of execution risks. So for example, if you look at case studies like Ant Group, for example. Maybe China comes on very hard down on China. But that's it. Singapore is also a highly regulated environment. Yeah. So what makes you think that we are highly different? So which is why it triggers you to think a lot deeper into all the different business models. And this is something that when I have that conversation with another fellow investor who's also an avid followers of business model, you're able to exchange thoughts and maybe look at things from a different perspective. And from this case, to me, Grab is no longer just a food delivery platform or a ride-hailing platform. To me, it's so much more. Right. And you can start discovering a lot of how they start earning profits, whether are they sustainable or not, whether they are shilling investors. Of course, I'm not saying that they're fraud or whatever, right. But I'm just saying if you to look at it from that perspective, how do you reevaluate this risk-reward? For example, even though I'm proud that Grab is a Singapore-based company, they're making their name renowned worldwide, being listed. You have companies like Razer as well. But on a fundamental level, if you look at the businesses, you analyze it objectively with a cool mind. Think about it. What's your end goal, and where do you want to achieve with these different developments? So this is really I love digging into these different businesses and think about companies like C Limited, companies like Lazada, companies like Alibaba, Tencent, how they're making money, and all your different other more popular companies out there. And there is also a reason why when you put your money in a certain company, rather than saying this company is yielding a certain CAGR for yourself, maybe a 20% CAGR, 30% CAGR, that's incredible, by the way. Warren Buffett only had like a 20-odd% CAGR, of course, of a very long track record. But rather than saying that you want to purely earn money from the stock market, I think there's a very important aspect of supporting the cause that you actually believe in. So, for example, you believe that Google is going to be the next big thing. You want to support maybe Amazon going to be the next big thing. You want to put money and have skin in the game. That's also a way for you to vote in essence. Put your money behind, or put your dollar behind the founder. Put your dollar behind the company, and hope that we make the world a better place, and express your world opinion in that sense. So investing to me really is that's how I qualify it. Apart from, of course, trying to fight inflation and just earn money on a very rudimentary level. So that's how I view it.
Cool, yeah. That's kind of like how I stay interested in investing as well. It's like beyond making money, it's being able to observe the execution in interesting strategies. You know, it can be anywhere in the world. That's what's fun about it. Just pick a company, you can just trace back their strategy for the past 5 years and see how it plays out, and then they'll give you some sense of where do you think the next 5 years is going to be, and you can sort of see how all the different players are fighting perhaps for the same market, and then test out your theories in a somewhat safe environment, because you don't have to put so much money in. Like if you wanted to, you can nibble at it and to see it and learn about yourself also, like how much risk you can stomach, like you said earlier. What type of investor are you? Because it's like a discovery phase. Actually, no one can exactly pinpoint. I'm 60% risk and 40% conservative. Like so it's an ongoing discovery, right? Cool.
I think at least on that point, right, about testing your own theory or testing your own strategy, right? I think one very important pitfall, or at least maybe I am constantly reminding myself as well, is there is always this ego thing at play, right? You want to know you're always right, because humans like to know that we are right. We like to know that our bets are right, how we look at things are right, how we read different narratives are right. But there comes a point where we will definitely be wrong somehow or another. And we need to have that wisdom to know that, hey, we're wrong. Let's move on. I think that's something I'm grappling with as well, because people have been. YouTube is a very open platform. I tend not to, or at least I never censor comments. So I don't delete comments. I take everything, and I sometimes read and I don't reply, because sometimes it might affect some of my feelings on how I felt that day. But that said, of course, people have been constantly bashing on a lot of all this Chinese tech, and there will definitely be a breaking point or tipping point to say that, hey, let's admit defeat, that, or maybe rather than saying that it's an ego problem, or as long as I don't sell out, I don't lose money. I think that's also a very toxic kind of mentality to have when you go into the market.
So many caveats to that statement, right, that you leave out.
Right. So that's the issue, right? Because in investing, there are many school of thoughts. And I think out of the many school of thoughts, there are definitely pros and cons to every single school of thought. You can be a trader, you can look at technical analysis, you can only care about fundamental analysis, you can look at growth investing, you can look into value investing. Nobody's stopping you. It's a free market. You can deploy your capital however you want to. But there are also a lot of oxymoronic statements in investing as well. So one will counter another. So in this case, you just have to be cognizant enough to really sort out your thoughts, and before going into or entering any position, you need to know what you're getting into. And this is also something that I love about investing. There is technically no 100% correct answer. There are only different perspectives. So, like I said, the Amazon, in hindsight, it looks like a stupid bet when you are holding from $100 to $3. But after all, we are back at few $1,000s highs. Same thing likewise in the dot-com bubble. Texas Instrument was at a highs of around 280 to 300, if I'm not wrong, off the top of my head. Today, it hasn't even traded back to its highs of the dot-com bubble. So how do you know that whatever you're picking today, is it the Amazon of the future or the Texas Instrument of the future? And then you are so stubborn to not release and to not find better opportunities out there, and you held all the way through. And worse still, if it's pets.com, it's missing. And that's even worse. So in that sense, you have to be constantly looking through a lot of your different investment theses. You have to be looking through a lot of the annual reports, how the competitors are doing. And stock picking is an extremely tiring game. It's an exhaustive game, especially when you're constantly in tune with the finance news. Today, Ukraine did something again. Oh, tomorrow interest rate is rising. This day, Jerome Powell said something again. It's extremely taxing. So if you do have something more fulfilling out there, like if you have kids to be with, You have a wife to take care, you have your parents to take care, you have a fulfilling life you have an enriching career out there. I would not venture people into stock picking, like I said. So it's good to just increase exposure, always remain exposed to the market, but stock picking, even though me being a kind of like a finance YouTuber or someone that talks about stock analysis, etc., by it's a disincentive for me to tell you to not go into stock pick because you will then not watch my videos. But that said, I think it's the responsible thing to do to tell people that, hey, this is kind of like a disclaimer or warning before you step into this entire black box of a stock market.
Right.
So definitely it's a lot fulfilling as well if you are able to generate consistent alpha and generate consistent returns. But that's it. I'm not going to discount. I'm not going to tell you that it's a bed of roses and it's just rainbows and donuts.
It's not for everyone, basically. Yeah, but if you are the kind of person that can stock pick, the YouTube community is out there for you to explore and enjoy.
Right.
Yeah. So I found it quite funny because when I started investing, my picture of it was you make good choices a few times and investing becomes this passive thing that sets you up for the rest of your life. And like how wrong I was is what I found out very quickly.
I think it can be though.
It can be if you have capital.
Right. It can be if you swing. I think there is this discussion from Warren Buffett. He said like let's say you only can. He gave out this thought experiment, right?
I remember that one.
Only invest like 10 times or 20 times in your entire life, you'll be extremely careful with your decision because every single one that you put in your money, you have one less decision in your entire life. And that also made people think a lot more before they pump in money or before they start pressing the buy button. But that also means that you have to be a lot more stringent, a lot more conservative, a lot more stingy with your calculations.
You
and
have to wait a long time before that opportunity falls within your requirements, basically.
Right. Yeah. And surprise, surprise, Munger didn't buy anything for the last 5 or 8 years, if I'm not wrong. And his next purchase was Alibaba. So it's the kind of temperament that you're equipped with naturally. And of course, and the later part of your years, you will also have the opportunity to hone your skill set. But along the ways, you're gonna screw up here, another. You're gonna take a lesson, or you're gonna take a beating from the market, one form or another as well. So that's really up to you to decide how you're gonna internalize the lessons and to come back stronger as an investor as well.
Cool. All right, Keng, thank you so much for your time. Where can new viewers from either of our channels find you on the interwebs? I
think you can definitely just type in my name in YouTube. I believe that I have a unique enough name. For people to Google me. I do post some Twitter content from time to time, but that's about it. I'm hardly active on Instagram, TikTok, etc. So I primarily operate on Twitter and YouTube. So yeah.
Thank you so much for your time.
Yeah, sure. Thank you.
Thank you. We hope you enjoyed our interview with Keng. One of the things I took away from this interview is that when he answered about the qualitative features of management, he didn't have to think about it for very long. He knew the execution of their management like the back of his hand. And that's what it takes to be a long-term investor in a company. You have to be basically a business owner or strategic partner. The other thing that I appreciated from this interview is that he takes on a macro view of the world economy, not just specifically in China or just in the US, but internationally. And that's very helpful, I think, as long-term investors because we need to have an open mind and see opportunities wherever we can. If you're interested to hear more from us, subscribe to our channel to get notified every time we release new videos about personal finance, investing, and more. Gently tap the thumbs up button for the almighty YouTube algorithm, and if you find this helpful, share this with your friends and family. We'll see you in the next video. Our guest tonight is an expert on Chinese companies, a long-time bull, Alibaba bull, and sorry, need to retake.
No worries.
It's like